Thus far in 2023, investors have largely received the best of both worlds as it pertains to a financial market backdrop. On the economic front, steadily declining inflation and above-trend growth, supported by a resilient consumer, has boded well. On the corporate front, healthier profit margins supported by robust cost-cutting have equaled better earnings. For the final months of this year, we can certainly find evidence to support that the next 3 months will look just like the first 9 months of this year. At the same time, there's plenty of evidence available for us to determine that the next 3 months and the next 6 months will be a rockier road. For this quarter, we have highlighted 3 themes just as usual. The first theme relates to the fixed income market, and more specifically about cash on the sidelines and why we think it makes sense to start taking a closer look at the traditional fixed income market. The second theme relates to the labor market and why we think the labor market does indeed hold the key for the path forward for the economy and corporate profitability. And finally, we'll discuss selectivity in the equity markets, why we think selectivity is warranted in equities today, and what that selectivity looks like. With money market funds yielding north of 5%, cash undoubtedly has a place in investor portfolios today. With that said, just as we've supported in previous commentary, we think it's time to start considering moving some of that cash into the more traditional fixed income market. With high-quality securities and fixed income yielding at levels that we haven't seen in 15 years, plus the prospect of price appreciation, we think this stance is warranted. Plus, it's worth noting that investing in the bond market after a Fed pause, instead of waiting to invest in the bond market after the Fed starts to cut interest rates, has historically been much more beneficial. Money market fund usage has surged on the back of a higher Fed funds rate, which is explainable. That being said, as we look towards next year with the prospect for future rate cuts, we think there's a potential wave of cash that could begin to splash the equity and fixed income markets next year, supporting prices. I think it's fair to argue that the labor market holds some of the most powerful indicators today. Consumer spending, which is the dominant portion of GDP, can be anticipated based on the health of the labor market. So too can inflation, as a large spread between the supply of available workers and the demand for available workers can influence the direction of prices in the economy. And finally, corporate productivity and profitability can be anticipated based on the health of the labor market. So when we look at the economy coming out of the pandemic, many employers were stretched thin looking for individuals to come on board, and they had to pay a hefty premium to do so. This put more money in individuals' pockets and pushed prices upwards. As we look at the indicators today, we have found a much healthier balance between the level of open jobs and the actual number of individuals looking for work. We can call this the jobs workers gap. So as the gap between the supply for labor and the demand for labor has started to close, we think that this is very important to watch, as getting closer to equilibrium on this reading should support a more healthy level of economic growth going forward. Given the labor market dynamics at play and a higher for longer Federal Reserve, we certainly think that we could see softer consumer spending and a slightly elevated unemployment rate as we work through the next 12 months. That being said, an environment as such doesn't necessarily dictate doom and gloom for the entirety of the equity market. We do think, however, that firms that are exposed to these high interest rates should be approached with caution. Firms that have a fair amount of leverage and are unable to healthily cover their interest payments, and those that generally have high yield credit ratings should be approached with caution. Some of these firms have performed well year to date, as investors have clearly said that the risks have been outweighed by the potential benefits. As we look at the slowdown phase of the economic cycle, which is likely where we are today, firms that are returning a large degree of cash to shareholders and possess fortress balance sheets have historically outperformed other subsets of the U.S. equity market. That's why at this juncture, we remain focused on quality and are focused on firms that are returning a good degree of cash to shareholders through buybacks and dividends, and firms that possess very healthy balance sheets with limited amounts of leverage.